If I were starting over today and I had to choose one account for long-term wealth building, the Roth IRA would be at the top of my list. In fact, for most everyday workers, the Roth IRA is probably the best account available. In this video, I'm going to talk about what a Roth IRA is, how it works, and why so many investors consider it to be one of the most powerful wealth building tools available. Let's get into it. Before we get started, my name is Matt, and this is the Everyday Wealth Builder, where we talk about personal finance, investing, and building wealth in a 9-to-5 job. As always, this content is for educational purposes only and reflects my personal opinions and experiences. I am not a financial advisor, and nothing in this video should be taken as financial, tax, or legal advice. Back to the video. So what is a Roth IRA? Well, the Roth IRA account was created as part of the Taxpayer Relief Act of 1997. It was a bill sponsored by Senator William Roth. Since its introduction in 1998, it has become one of the most popular retirement accounts, mainly because of its tax-free growth potential and flexibility. What is an IRA? That is an individual retirement account. Unlike a 401k plan, which is sponsored by an employer, an IRA account, traditional or Roth, is something that anyone with earned income can open for themselves for retirement. And let's make a clear distinction. A Roth IRA is not an investment, it's an account. Think of the Roth IRA like a toolbox. Toolbox holds tools that builds things. Roth IRA is an account that holds investments that builds wealth. That's simple. So why do investors love the Roth IRA so much? With a Roth IRA, your investments can grow for years, even decades, without creating a future tax bill on those gains, so long as you follow the Roth IRA guidelines. One reason younger investors love the Roth IRA is because they have two things working for them: time and a lower tax bracket. Early in their careers, most people aren't earning as much as they think they are going to later in life. Because of that, they are comfortable paying taxes on earned income now for a tax-free retirement in the future. Think about it like this. If you invest consistently for 20, 30, 40 years, even a relatively small amount of contributions and investments can compound into a very large portfolio. With a Roth IRA, qualified withdrawals are completely tax-free. Even if you're not in your 20s, the Roth IRA is still an extremely valuable tool. The principle is the same. The more years you have until retirement, the more your money grows. So what is the difference between a Roth IRA and a traditional IRA? The easiest way to think about it is when you are taxed. With a Roth IRA, your contributions are made after taxes. With a traditional IRA, your contributions are tax deductible. What that means is with a traditional IRA, it will lower your taxable income. A Roth IRA grows tax-free over the years. A traditional IRA grows tax deferred. Your Roth IRA, your withdrawals are completely tax-free if qualified. Traditional IRA, you will pay a tax on that withdrawal. With a traditional IRA, you only need to be age 59 and a half to start making withdrawals. With a Roth IRA, you need to have that money in that account for at least 5 years and be 59 and a half before you can make those withdrawals. Now, these next two pieces are very important: early withdrawals and penalties. With a Roth IRA, your contributions, not your gains, can be withdrawn at any time. With a traditional IRA, you are penalized and taxed on any contributions you want to withdraw early, and the income limits between the two. With a traditional IRA, there is no income limits. With a Roth IRA, once you reach a certain income, you can no longer contribute to it. However, if you are over that income, there are ways to contribute to a backdoor Roth IRA, but that's a topic for another video. So who can contribute to a Roth IRA? For most Americans, contributing to a Roth IRA is pretty straightforward. You just need to be below a certain income limit, and you need to have earned income from qualified work. Things like a paycheck, commission, tips, and self-employment are all qualified earned income. Any income from investments themselves generally do not qualify. However, there are income limits that determine if you can contribute directly to a Roth IRA account. For the purposes of this channel and the everyday 9-to-5 worker, you are most likely below those limits. So how much can you contribute to a Roth IRA? Well, for the 2026 year, the contribution limits for someone under 50 years old is $7,500. For those over 50, you get a catch-up allotment of $1,100, making your total $8,600 for the year. Most people automate their contributions to make it easy so they don't forget to contribute. Well, what happens if you contribute too much to a Roth IRA? It's pretty simple. You can either remove the excess from the account or be charged a 6% penalty on however much you put in extra. To make it simple, if you put in $8,500 and the limit is $7,500, you will get taxed 6% or $60 on that additional amount. Now, if next year you only contribute $5,000, that extra $1,000 will be put over that $5,000 to make it $6,000, and that penalty goes away. The important thing is to not ignore the mistake. If you put in excess contributions, talk to your brokerage and they will help you out to fix it. So now you have money in your Roth IRA. What should you invest in? Well, there are multiple things that you can invest in once you have money inside your Roth IRA account. Depending on your brokerage, you can invest in index funds, ETFs, stocks, bonds, etc. Let's do a quick overview of indexes and total market funds. A lot of investors typically just invest in market indexes, such as the Dow Jones, the S&P 500, the NASDAQ, and the Russell. These indexes are a good way to have your money grow at the rate of the economy. But what if you want to mix it up a little bit? There are such funds known as total market funds. Funds such as VTI, which is the total US stock market index. There's VXUS, which is the total international stock market index for countries outside the US. And there's a global fund known as VT, which is comprised roughly of 60% US and 40% international. Beyond broad market index funds, investors can also choose more specialized funds that focus on specific goals, industries, and investment strategies. Some sector funds, or ETFs, can be for technology, utilities, energy. Income-focused funds and ETFs can be focused on dividends, covered calls, or REIT strategies, or real estate investment trusts. You can go towards mutual funds from providers such as Fidelity, Vanguard, Charles Schwab, or you can invest in alternative assets such as gold, silver, or commodities like energy and agriculture. Well, what if you're an investor that wants to own a specific portion of a company? Well, that's where individual stocks come into play. With individual stocks, you have the potential for higher returns, but that also comes with higher risk. And if you don't have a financial advisor, you need to do research on the companies that you want to own. Let's say after years of contribution, you're ready for more advanced investment strategies. Well, the more experienced investors may use options, leverage ETFs, or other advanced strategies inside of a Roth IRA. While this is not where I would tell beginners to start, this is still an option that should be discussed. If you're feeling overwhelmed by all these choices, that's completely normal. There are thousands of investments available. You don't need to own all of them. Many successful investors build significant wealth with just a handful of broad market index funds. The goal isn't to find the perfect investment. The goal is to find investments that align with your goals. Continue to invest regularly and watch those investments grow. What are some of the common mistakes and opportunities of the Roth IRA? Well, the number one mistake people make with a Roth IRA is contributing money but never putting it into investments. So the cash just sits there for 20, 30, 40 years, and you end up missing out on all that growth potential. Another mistake is people waiting until the last minute to contribute to their Roth IRA. If you wait until the last minute to contribute and put those contributions into investments, then you are missing out on potential gains. Now, while waiting until the last minute is a problem, there's an opportunity to be had in that problem. With a Roth IRA, you have until that year's tax deadline to make contributions. What that also means is that if you have extra money sitting around, you can also put in the next year's contributions as well. What that means is that you can put 2 years of Roth IRA contributions in at the same time. So let's say January 2027, you haven't put anything into your Roth IRA. Well, the contribution limit is $7,500. And let's just assume that the contribution for 2027 is also $7,500. That means January of 2027, which is before the tax deadline of 2026, you could put in $7,500 for 2026 and $7,500 for 2027, thus giving more principal for your account to grow. But with that, you don't always want to do that. You want your contributions to remain consistent. And that's where mistake number 3 comes in. If you are inconsistent with your contributions, you are inconsistent with your potential wealth building journey. The more you contribute, the more your investments grow. The final mistake is ignoring income limits. As your income grows, there is a phase out period for you being allowed to contribute directly to a Roth IRA. High income earners need to understand these rules and may need to consider alternative methods to invest in a Roth IRA, such as the backdoor Roth IRA. Most Roth IRA mistakes aren't caused by choosing the wrong investments. They're caused by not contributing, not investing, and not being consistent enough to let compounding take effect. So should you open a Roth IRA? While everyone's situation is different, I believe the Roth IRA can be a great option for many investors, especially those early in their journey. Younger investors often have decades before retirement, giving them plenty of time to benefit from the compound growth that comes with the Roth IRA. The Roth IRA can also be attractive for investors who like the idea of paying taxes today so they have tax-free withdrawals in the future. Where should the Roth IRA sit on your list of priorities? As powerful as a Roth IRA is, if you don't have an emergency fund or high interest debt paid off, or if you're not contributing to a company matched 401k, I don't think the Roth IRA is for you just yet. You want to be sure you get out of debt first, have an emergency fund saved up, or if your company offers a 401k, you contribute to that first. Remember, personal finance is personal, and the right next step all depends on your financial overall well-being. Remember, y'all, the Roth IRA isn't a get-rich-quick scheme. It's simply a powerful tool that allows ordinary, everyday people to invest and build wealth. Whether you choose broad market indexes, stocks, or advanced strategies, the most important thing in a Roth IRA is getting started early, being consistent with contributions and investments, and giving your money time to grow. The Roth IRA may not be the perfect account for everybody, but for the everyday wealth builder in a 9-to-5 job, it's an extremely powerful tool to help you along your journey. If you found this video helpful, please consider liking, subscribing, leaving a comment. On this channel, we focus on personal finance, investing, and building wealth with the everyday investor one step at a time. Thank you.